Hello and welcome to Bloomberg Quint Live, and you're watching Trend Spotting. I'm Navneet Saluja D'Souza.
Good afternoon, Navneet. I'm Agrawal, and in the next 30 minutes, we deep dive into specific trends in the markets to draw our key takeaways and their implications for investors. First, the headlines. Tepid Thursday on the last trade as both benchmark indices trade with marginal cuts on the F&O expiry day. Broader markets outperform. India VIX turns negative. And Tata Steel wants to revise its bid for Electro Steels seeks some more time from Resolution Professional. And IDBI Bank gains as much as 8% in morning trade after it gets the highest amount in the government's recapitalization plan. And Maruti and Dr. Reddy's are the two big earnings for today.
All right, let's take a look as to what's happening with the markets today. Today is the last day for the January series, and you can see some bit of expiry day jitters on the screen today, as we've seen a bit of cut for both Nifty as well as Bank Nifty. We'll just pull up those plates for you. But clearly, today is the day when the PSU banking index that's reacting to that news of the recap allocation, which was announced yesterday. And you can see profit booking. Nifty PSU banking index currently trading at its lowest point, down almost 4%. Let's just pull up the India VIX. Remember, that's been going up, but some bit of relief actually in today's trading session, as India VIX now is at its lowest point, 17.36. Remember, it had crossed the mark of 18 in yesterday's trade. Well, in terms of broader markets, the picture is just the same. We've seen profit booking coming back. Remember, broader markets were under pressure yesterday as well. So the BSE mid-cap and the small-cap index are trading with mild bit of cuts. Let's just pull up the advanced decline ratio. That's going to tell you the actual picture as what is happening in the markets today, and it is in favor of the declines. As you can see, 2:3 is the ratio in terms of NSE stats right now. Let's just pull up the contributors list among the Nifty constituents: ICICI Bank, L&T, HDFC Bank, and Kotak Mahindra Bank. So clearly, the private banking lot is contributing the most. On the losing side, you've got the heavyweights: State Bank of India, Infosys, Reliance Industries, and HDFC, which are capping the moves on the upside.
Well, underneath in the broader markets, I'm tracking getting some traction in Kaplan Point Laboratories, which is up around nearly 7% in today's day of trade. And that's followed by UCO Bank, which is also advancing as much as 5%. We have gains in NCC, which is up nearly 4.7%. And NIT Technologies continues its up move by as much as another 4.5%. On the losing end, well, there has been a lot of weakness in the relatively smaller mid-cap banking counters, such as Indian Bank, Syndicate Bank, Union Bank of India. So relatively larger ones such as Punjab National Bank and Bank of Baroda also looking at substantial weakness. So the large part of the weakness is coming from the public sector banking space underneath. But on the whole, as you pointed out, it's largely evenly poised, with the advantage this time going as far as with the declines for now.
Okay, that's about the markets. But on Trend Spotting today, we decode the December quarter numbers for Raymond as we connect with the Group CFO, Sanjay Bahl. What's aided Motilal Oswal's financial services a strong quarter three? We asked the co-founder Raamdeo Agrawal. Will Maruti Suzuki manage to race ahead in quarter three? We get an analyst view from Ankit Merchant of SMC Global Securities. And what is Jio spoiling the party for other players? We cover all of this in the next 30 minutes for you. Well, on to our first trend of the day. Motilal Oswal Financial Services has reported strong set of numbers for the December quarter, with the asset and wealth management and capital markets arm contributing to the 66% growth that one has seen in the third quarter when it comes to the bottom line. What have been the key factors at play here? Let's ask the management. Joining now on the show is the co-founder, Mr. Raamdeo Agrawal. Good morning, sir. Thanks a lot for joining us today on Bloomberg Quint, and congratulations once again, a strong set of quarter for you, where you've reported the highest ever quarterly top line and bottom line.
Good morning, and it has been a very good quarter for the capital markets business, and we have gained in every segment of our businesses, whether it is broking, whether it is wealth management, asset management, distribution of the third-party products, even the treasury, which is invested in the equity products. So all in all, everything has done well, and it has resulted in a 66% growth. Actually, if you look at our Aspire, the mortgage business, the growth is actually more than 100%. So it's literally fantastic performance, and it's a absolutely unqualified good quarter.
So, Mr. Agrawal, my question was to do with your investment banking division, which has grown twofold. In your press conference, you said that you will close 11
Yes.
deals, if I'm not mistaken. So, can you tell us a little more about the traction that we can expect, and
Yes.
perhaps what's in the pipeline as we move into the next couple of quarters?
Yes, so pipeline is very strong, and we have a lot of deals, large deals likely to happen. And the good thing is that there is very little friction now. The deals are going through very smoothly, and the deal pipeline is also building up very, very quickly. So there are not many failed deals, and we have been able to bring out IPOs, of which listing has happened very, very successfully. So right now, I think that's a segment in the capital market which has done by far it's like a 200% up. So though at the beginning of the year it was a little hesitant, but as the market is becoming warm and levels are high, sellers and buyers both are kind of coming forward to conclude deals. And I think the ease of doing business also is contributing, where the corporations are willing to take over the smaller companies and make it part of their larger operations. So the outlook for this particular segment is, I would say, the brightest of all.
Mr. Agrawal, so broking is doing well, IB is doing well, but one pressure point which I can see in your earnings is the housing finance segment, where asset quality has deteriorated. And if I'm not wrong, I guess the disbursements for the quarter have also been on the lower side. What's going wrong here?
Yeah, so it all trouble started with the demonetization. That was more than a year back, when we didn't have. I mean, it was our mistake that in a lending organization we didn't have a collection mechanism, separate collection mechanism. Collection was done by the people who were doing the sales and credit sales. So the same people were collecting, and there was not much of a problem in collecting the money at that point of time. Maybe the book was also relatively small. But as the demonetization hit the segment, and it hit the affordable segment the maximum, the weakness in our organizational setup was clearly the reason we found. I mean, we found that we were struggling to collect all the money, and the people were required to be approached 2 or 3 or 4 times. So clearly we were lacking that organization. Now we have put up about 150 people. They are coming on the stream, they are getting trained, and we are seeing more results. I mean, we have still not seen the results coming by, because the actual gross NPA has moved up from Q3 to Q4 from 2.5% to 4.5%. So clearly the impact of whatever we have done has not been felt, but we think this quarter is starting, things will come under control.
Mr. Agrawal, again, your traditional broking business, fantastic growth. So how much of this is correlated to the way the markets have been moving up? Because in 2017 has been a fantastic year for the markets. Should we see some consolidation in the markets? So can we expect, some slackness to come in this segment?
Yeah, it all depends on what happens in the marketplace, because this is clearly trended business. As the security prices go up, the turnover, because people book profits and buy into the new stock, so that turnover contributes to our broking this thing, and more clients join in. So one is the existing client does a lot more business, and you see a lot of more clients, bigger clients coming in. So if the market takes a break, I mean, market remains at the current levels, I don't think impact is that much. But if market actually breaks down, then the impact is going to be far more severe. But the outlook looks to be pretty stable right now.
Mr. Agrawal, this is not the first quarter where the wealth and asset management business for you has done well. It's a segment which has been doing well for the past few quarters. Do you think you'll be able to sustain the kind of run rate that one has seen here? Because we're seeing assets under management going up.
We have done very well, extraordinarily well in last 3-4 years, I mean, one would try to maintain the momentum, the gross inflow, the performance. I think the real challenges in this business, particularly in asset management business, is not getting the money. I mean, now we have got a lot of money. 35,000 crores is a lot of money. So, we are going to, for sure, we are going to get more money. The issue is to keep the performance up, and I mean, we keep trying our best, and I'm putting more resources, more number of hours, and the focus is completely to see that the assets which people are interested to us is well taken care of, because our own net worth is also fully involved in this particular line of business. So, I mean, the real issue, because the markets are more pricey, the new ideas are not that easy to come by, and whatever new ideas we get, they are fairly priced. So how do you beat this wonderful market and justify your active management fees? So that is a challenge of this business. But otherwise, I think till date the performance is good, inflow is good, everything is fine.
So talking about the domestic liquidity into the capital markets, that's been great in the year of 2017, and the flows that one has seen in the equity mutual funds have also been good. I just wanted to check, have you gained any sort of market share here in the previous quarter?
Yes, we are continuously gaining market share because our flow is, because of the small base, our flow is much faster, and every month, every quarter, we are gaining market share. I mean, I don't see that much in terms of market share. The numbers are there in our presentations. So our flow, we might be, say, for about 9 lakh crores is the total kind of equity even between PMS and mutual funds. So of that, we are managing about 35,000 crores. And so that works out about a little less than 4%. I think our net inflow right now of the entire system is about 5%. So we are slightly ahead of how much money we are managing right now.
Mr. Agrawal, before I let you go, your shareholders are a happy lot considering the stock price has risen so much in the last 1 year. Any message for them?
Yeah. I mean, yes, they've done well, and they must. I mean, we need their blessings to keep doing well. I mean, and we have declared one of the highest interim dividend. We have given 4 rupees equity, this thing as 25% payout ratio. So I wish them a good time staying invested with our stock.
All right, Mr. Agrawal, we'll leave it at that. Thanks for joining us and taking us through this quarter's numbers. It's been a very, very good quarter indeed for your company. And of course, we will be watching out for more developments and updates. But with that, we'll move on to, well, another set of earnings. And it has been a good December quarter for Raymond, with the company reporting a profit of as much as 29 crores this time around, as compared to a loss of 16 crores in the corresponding quarter last year. What have been the key factors at play here? Let's ask the management. Joining us on the phone line is the Group CFO, Sanjay Bahl, and also joining us is our very own Yatin Mota, who tracks the counter very closely. So, Yatin, well, it's over to you.
Thanks for that, Agam. And Mr. Bahl, first of all, congratulations for a strong set of earnings. I would like to ask what have been the growth drivers for the company this time around. Of course, your apparel and your textile business has done well. But apart from that, which are the growth factors contributing to such a strong earnings?
Well, I'll give you the highlights, and I'm happy to share that in this quarter, the performance across all our business segments is on track with the growth momentum being maintained. If you look at what has underpinned this profitable growth in the quarter is, of course, that the branded textile business has grown by 18% on a like-for-like basis. A branded apparel business has grown by 16%. Our garmenting business has grown 26%. And our engineering business is grown 26%. Auto component has turned in very strong growth at 30%. So if you see across all our business segments, we've seen aggressive growth. And our margins have improved by 246 basis points. And that has resulted in improvement in our PAT numbers as well. Operational efficiencies and working capital management have also resulted in improvement in our working capital position by nearly 5 days, a reduction in our working capital cycle. Free cash flows have been positive during the quarter, even though we've had a heavy capex in this quarter. So overall, a very satisfying quarter, and we can now say that the demonetization issues and GST transition issues are now behind us, and we look forward now to maintaining this growth momentum into quarter 4 and the next year.
Sir, taking that word forward, you spoke about GST transition and demonetization impacting your business, especially the branded apparel business, which was impacted for the last 1 or 2 quarters. If you could tell us what kind of growth trajectory do you expect for the branded apparel business moving forward, since the transition periods are behind us, and more importantly on the franchisee network and on the distribution network, how really are things shaping up for the company?
So I'm happy to state that in the branded apparel business, we've now seen 10 successive quarters of growth of nearly 16%, except for one quarter which is quarter 3 of last year, which was single-digit growth. Other than that, it's really the businesses, 4 brands have scaled up significantly. We have a clear path to profitability in sight for getting to our double-digit EBITDA margin growth for the branded apparel business. Of course, the growth is underpinned by the strategy that we have of investing in the brands for the 4 power brands that we have in our portfolio. What is also being executed very successfully is the expanding the entire wardrobe solutions within our brand, and that is what is resulting in better and higher customer realizations and improved sales productivity in the outlets. From a retail footprint perspective, we've been aggressive this year. We've expanded in the 9 months of this year 118 stores. We are looking at adding another 75 stores in quarter 4. So at a net level, after I account for the store closures, we would be around 150 stores in the year. And similar expansion plan in the retail footprint is envisaged for next year as well. And I must also hasten to add that our strategy has been to look at an asset-light expansion strategy, and nearly 70% of our expansion is through the franchisee route.
Okay, and so specifically about your FMCG business, wherein the growth has been good. So talking about new product launches and what kind of a ramp-up plan do you have there as well?
Yeah, so if you look at the FMCG business, clearly we see the FMCG business as an important driver for value creation for the Raymond Group, and a very integral part of our Raymond Reimagine strategy. We clearly see to expand the product portfolio that we have in the men's grooming space. We recently launched the One Park Avenue range, and we clearly seek to extend the global presence of this brand as well. So there is a lot of traction that you will see in the FMCG space over the next few quarters. We'll have a lot to report on this for sure. We also, as you know, we have acquired Kama Sutra brand, and we are looking to develop our sexual wellness portfolio under the Kama Sutra brand as well.
Okay, good to know that. And without asking you, the question relating to Thane land, I cannot let you go. So if you could tell us if there are any interesting developments on that front, or you could have some updates there for your investors.
Yes, I know I've been always mentioning to you that there is a lot of work which is going on, and so I can reiterate that a lot of progress has been made, both on our own development plans, evaluating our development plans and feasibility analysis, secondly on the regulatory aspects as well. However, it is still early for me to share any news with you. But I'm very hopeful that and confident that the next time we speak, I will certainly have a more specific update to give you on this.
Thank you so much, sir, for joining us and speaking to Bloomberg Quint. So that was the management of Raymond, quite confident on the growth prospects moving forward, and probably in the next quarter they will have some significant updates relating to the Thane land monetization plan. With that, it's back to you, Agam and Navneet, in the studios.
Thanks for that, Yatin. Well, that was the management of Raymond. Well, the numbers were definitely good, but what you're seeing on screen is some bit of profit booking as the stock has more than doubled in the last 1 year. Let's move on to the next trend. Reliance Jio has managed to turn profitable in just over a year's time. The country's newest telecom operator, which continues to capture market share, has already overtaken Idea Cellular despite having a smaller subscriber base. But did either of the two listed competitors, Bharti Airtel and Idea Cellular, share the same optimism in the quarter gone by? Somit Sarkar put together a comparison based on the key parameters. So, Somit, what's the verdict?
So we'll see to that. We'll come to that. So far, of the top 4 telecom companies, 3 have come out with their numbers. So let's see how they stack up. Now, as of December ended quarter, the Airtel subscriber base stood at around 29 crore. That of Idea at 18.9 and Jio's 16 crore. So Airtel's 29 crore subscribers give the company a revenue of close to 10,700 crore, while Idea's 19 crore subscribers give the company a revenue of close to 6,500 crores, while Jio's 16 crore subscribers give the company a revenue of 6,879 crore rupees in the third quarter of financial year 2018. Now these are absolute numbers, but if you see the growth, only Jio's revenue has grew compared to the last quarter, while that of Idea and Airtel has fallen by around 13% and 12%, while that of Jio has increased by 12%. Now, if you see EBITDA, we can see a similar trend is there also. Jio's EBITDA has increased by 82%, while that of Idea and Airtel has fallen by 19% and 17%. And when you see on the margins, EBITDA margins of Jio was the highest at 38.2%, followed by that of Bharti Airtel at 32.6%, and then Idea Cellular at 19%. Now, moving on to average revenue per user, that is the key number for a telecom service provider. Now, Airtel's ARPU stood at 123, and this is for the India wireless business. Idea's ARPU stood at 114, while that of Jio at 154. Now, Jio's ARPU was the highest in the industry so far. Now, if you see that ARPU of all the 3 operators have fallen compared to the last quarter, but Airtel's ARPU has fallen the most. It fell by around 15% compared to the last quarter, while that of Idea by 14% and Jio's by only 1%. Now let's see on the balance sheet side how the debt and the leverage ratio of the telecom companies have been worked out here. Now Airtel's net debt stood at 91,700 crore, Idea's net debt at 55,700 crore, while Jio's net debt at 52,000 crore rupees. Now if you see on an absolute number, this is Airtel's consolidated net debt is the highest in the industry, but its leverage ratio is still the best. The net debt to EBITDA of Airtel is at 3.1 times, while that of Idea is the highest at 11.4, while Jio stands second at 5.3. Now moving on to some key parameters which are non-financial. Now the data consumed by an Airtel subscriber per month was 5.3 GB, while that of Idea was 4.7 and that of Jio was 9.6. Now these are absolute numbers, but if you see the growth, only Airtel's data consumption growth was around 31%. Moving on, can you just bring up the data consumption chart? So yeah, Airtel's data consumption grew by 31%, while that of Idea by 25%, and Jio's it was flat. Now in the last quarter also, the average data consumed by a Jio user was 9.6 GB, and this quarter also it remains same. Lastly, on the subscriber attrition rate, which tells you the number of subscribers which choose to discontinue their services, Airtel was at 3.3%. 3.3% of the subscribers chose to discontinue their services. Idea was highest at 4.8%, while Jio was lowest at 1.4%.
So what's the verdict, Samit?
So Jio has beaten Airtel and Idea in most of the...
Absolutely, quite, yes.
And kudos to you for tracking every data plan that hits the market, not only tracking and analyzing and seeing the impact on the incumbents.
Well, there you have it, guys. Those are some extremely important data points that are coming through, and I suppose we will have this trend, and Samit will continue to give us more details with respect to these trends in the telecom space. But continuing with earnings discussion, there's one of India's biggest car makers, Maruti Suzuki, is expected to report its December quarter numbers today. Will Maruti Suzuki race ahead this time around with raw material costs and impacting the car, as well as several other factors? Of course, we all know about the kind of volumes we've seen for the December quarter with respect to Maruti Suzuki. So let's discuss this and take this forward with Ankit Mantri, research analyst at SMC Global Securities. Ankit, good afternoon. Thanks for joining us. Let me just start off with your expectations on Maruti Suzuki. I know it's had a great quarter with respect to its volumes. This is partly on account of low base due to demonetization. What is your expectation with the numbers?
So coming towards the expectations, in the quarter three, company had a volume growth of near about 11.8%. So in absolute terms, it was 4,30,000 something units. We expect the revenue of 19,980 crore in this particular quarter, which is 18% growth, considering that the realizations are likely to improve by 4.5% year over year. One is due to the contribution of Vitara, Brezza and Baleno to the overall sales. Coming towards their EBITDA, we expect EBITDA of 3,127 crore with an EBITDA margin of 15.65%. So which is likely to be 89 basis points higher compared to a year over year, but it is likely to fall by 124 basis points quarter over quarter. So we believe the discount which was given by Maruti during the December.
Right, Ankit, sorry to interrupt. We just need to flash the Dr. Reddy's quarter three earnings. That's been flashed on the screen. The profit for the quarter, this is the consolidated figure, 303 is the one, and our expectation, the poll was throwing about a figure of 337. So it is been below estimates. Total revenue from ops is around 3834, and remember our estimates were throwing a figure of 3688 crores. So on the top line, revenue from ops has been above what the street was estimating. But if you look at the net sales, that's been 3616 for the quarter. Well, the finance cost has gone down sequentially. I'm comparing the number for finance cost. That's 172 versus 223. So on the bottom line front, definitely the numbers has been slightly below what the street was estimating, but I guess the top line has been slightly above that. The finance cost sequentially has gone down. That's one big positive takeaway from here. Well, if you look at the other expenses for the quarter, we've seen the other expenses also going up. So 850 versus 761 is sequentially, but on year-on-year basis, on operating level, I guess they have done some bit of cost optimization. We'll just get you the EBITDA margins for Dr. Reddy is going. Remember, our expectation was 18.8, which was suggesting a degrowth if you compare it on year-on-year basis. In the corresponding quarter, the EBITDA margins were somewhere about 23.9%. But remember, because of the pricing pressure, we've seen the margins of all these pharma companies deteriorating in the past few quarters. If you look at the stock price right now, it is definitely off day's lows. So looks like the street is taking the numbers in on the positive side, considering the top line as of now has been what the street was estimating. The revenue figure is there on your screen, 3844 versus what the street was estimating, a figure of around 3688.
Again, Navneet, it seems like a lot of these earnings were largely factored in by the market, going by what we've seen in the earnings reaction on the on the stock price. It really hasn't moved too much. In fact, it's still just marginally in the red and moving around that range. I'm not sure if...
So I've just got the segmental breakup as well.
Right.
Like, I'm sorry to interrupt.
Sure.
The global generic side of the, if you look at the EBIT for this quarter, it's 1791 versus 1964 on year-on-year basis. But I want to highlight sequentially there's been a growth in terms of EBIT, because in the September quarter it was 1693. Whereas if you look at the pharmaceutical services and active ingredients, that segment, that's just been about 130 versus 153 on year-on-year basis. But on sequential basis, once again there has been uptick. So if you look at all the segments, pharma, services and active ingredients, global generics, proprietary products, on sequential basis, at an EBIT level, there has been some bit of growth which has been seen, but on year-on-year basis, it is expected because the base is higher, and we've seen pricing pressure being there in the pharma space. So that was pretty much in line, I guess, what the street was estimating.
Absolutely, Navneet. I'm not sure if we are going to have someone to analyze these numbers. All right, so, well, can we go across to Shraddha right now? Okay, so yeah, we have Shraddha Babla, who's also looking at the numbers right now. Shraddha, tell us what more have you seen in the earnings from Dr. Reddy's?
Okay, I'm just going to talk about the revenue numbers first. They've come in at 3616 crores versus a number of 3688 that the Bloomberg consensus numbers threw up. So a marginal miss there. And the net profit number has come in at 303 crores versus an expectation of 337 crores. So a small miss coming in there as well. Just a couple of things that I want to point out. One is that they have said that there is a one-off charge of 87 crores that they've taken in the quarter on account of a new tax law in US. Secondly, they've also said that in the quarter they have entered into a settlement agreement with the US Department of Justice with respect to a litigation that was for 5-blister packed prescription products. So based on this settlement, the company has agreed to pay 32 crores to the Department of Justice. Again, this has been provided in this quarter as well. So two one-offs are actually causing that miss as far as the bottom line numbers are concerned. That apart, I believe Navneet has already spoken about how the segmental performance has been. Let's look at the gross margin number. I have that right now with me. The gross margin number has come in at 56.3%, and the EBITDA, which the company has calculated, has come in at 806 crores. But the company calculates EBITDA differently, so not the correct way to look at the EBITDA number. I am also trying to get some other numbers. Okay, gross profit, they have said, has come in, has seen a degrowth of about 2%. That's broadly in line with what we were expecting. Results from, so EBITDA has also come in about 13% lower, mainly on account of that 93 crores impact on account of the tax reforms in US. That apart, revenue mix, if you look at that on a segmental basis, global generics overall has degrown by 2%. I believe we were looking at a flattish growth as far as the global generics is concerned. North American revenues have done relatively better. There's a degrowth of 3% versus an expectation of a degrowth of about 10%. As far as the Indian operations are concerned, the numbers seem to be a slightly on the disappointing side. We were expecting the domestic business to grow by about 10%, but it has grown by about 3%. So we'll have to understand what has led to this underperformance in India. Broadly, Europe was expected to hold up and grow by about 15% or so. That has degrown by about 7%. So we will have to understand what has led to the underperformance as far as the European and Indian businesses are concerned. So broadly, numbers do seem to be a miss, but a lot of one-offs that are at a play here.
Right, Shraddha, I think we're also flashing the margins figure on the screen. I think the margins are somewhere about 20% versus our expectation of 18.8. And remember, we've highlighted at the operating level, the numbers are looking better than what the street was estimating. And I was highlighting sequentially the performance is looking better. Obviously, on year-on-year basis, there's no comparison. Reason being there has been price erosion. And sequentially, the uptick has come from the North America side, because if you look at the growth, the revenues from North America sequentially have seen a growth of almost 12%. But let's go and get some analyst view on the numbers that we've just got of Dr. Reddy's. Praful Bora, VP of Equirus Securities, is joining us on the show now. Hi, Praful. Thanks a lot for joining us. What are you making of the numbers that we've got for Dr. Reddy's? Praful, if you can hear us, what are you making of the Dr. Reddy's third quarter earnings? It looks like at an operating level, the margins have come above what the street was estimating.
So I think definitely margins are on the better side, and also the US business has been much better than what was anticipated. I think that probably would have led to the the beat in the margins.
Okay, so Praful, how are you reading the consolidated numbers on an overall basis? What is your view? Is this largely in line, above, below your expectations?
See, it's slightly above the expectation at the operating level. I think there has been some tax, deferred tax, liabilities which have come up because of the tax changes in the US. So I think that has led to the lower PAT. But I think at the operating level, they have been above estimates. So I think I would rate it positively.
Okay, Praful, then in that case, are there any concerns that you'd be looking out for when we speak to the management later on?
So I think the numbers, it's pretty okay. I don't think so the numbers are a disappointment at all. One, I think, last month they had a call with the FDA for Shikakulam clearance. I think that will be one key monitorable that people will look at, because that will decide the course of molecules like Copaxone.
Well, Praful, they've highlighted for the global generics, year on year, there's been a decline of 2%, which is primarily on account of adverse foreign exchange as the dollar had depreciated by almost 4%. But what I want to ask is, it's a known fact that there is pricing pressure in the pharma space, which still persists when it comes to the US market. But do you think in terms of prices, we may have bottomed out, and going ahead, the growth trajectory could look better for the pharma companies?
See, I think probably this quarter onwards, we would see some impact from the WBAD and the Econdas merger. I think, having said that, that is largely what is known. So probably for the next 1 or 2 quarters, you can still see some pressure. But I think, the recent comments from Sun Pharma's, Mr. Macau, as well as, I think, what I get, the sense that I get from talking to some of the companies, I think probably we are, closer to the bottom of the price erosion cycle now.
Okay, Praful, we leave it at that. Thanks for joining us and taking us through the numbers. But we'll move on to another very important earning from the pharmaceutical space, and that is Biocon. And Biocon did report a subdued third quarter. The net profit of the Bangalore-based firm fell by as much as, 45%. And this was mostly on account of lackluster sales from small molecules, biologics division. And to discuss the earnings in detail, we are joined by Ms. Kiran Mazumdar-Shaw, Chairperson and Managing Director of Biocon, on the phone line from Bengaluru. Ms. Shaw, thanks for joining us. My first question will have to do with the small molecules, segment. The revenue has shown degrowth over last year. What's the reason for the drop, and what's the outlook with respect to this specific, segment?
Well, the small molecule segment has been facing a lot of headwinds because, there have been channel consolidation headwinds. There's been pricing pressure on some of our APIs. Having said that, our immunosuppressants have done extremely well, so that's offset some of the headwinds we've had in our other APIs. But having said that, I think what we are really focusing on in small molecules is really to propel this particular segment with our ANDA generic strategy that has begun to deliver for us. We have just entered the US market with our ANDA generics, and we believe that this will start gaining traction over the coming quarters. We have a pipeline of generics that will start really getting the real opportunities kicking in from 2020. So we believe that the small molecule segment will only start really, delivering good sustainable growth from later next fiscal. So we are seeing those headwinds in small molecules, but having said that, you can see that our biologics business, although we've seen a bit of a muted performance this quarter, on a year-to-date basis, we have seen, at least growth, and much of this growth has been impacted because of the requalification activities pertaining to our facilities, which are now behind us. So we believe that from Q4 onwards, you are likely to see a good, smart recovery in biologics, which really is one of our principal growth drivers. Research services has begun to fire again, 17% year-on-year growth, and expects to end the year on strong double-digit growth, and has signed up with BMS, one of its marquee clients, up to 2026. It has expanded its partnership with Amgen. It expects to enroll other large marquee clients going forward. So I think that business is in good shape. So I think we are seeing revival starting Q4, and we expect to see smart recovery in next fiscal.
Right. Ma'am, what's the sort of run rate with regard to R&D spends that you will be looking at in the next 3 to 4 quarters, or if you could tell us for FY19?
Well, if you looked at our regular kind of spends every year, it's anywhere between 400 to 500 crores. And as you know, biosimilars is a very expensive business. Of course, these spends are really kind of skewed towards the clinical phase. Many of our clinical trials either are in advanced stages of phase 3 trials. Some of them have entered phase 1, such as insulin aspart. So we expect this run rate to continue, but adding to this is, of course, our novel biologics, which is also going to incur some R&D spend. So you can expect this 450 to 500 level of annualized spend in R&D. But as you know, R&D is very core to our business and is very reflective of our advancing assets.
Can you give us timelines on the re-inspection of the Bangalore Biologics facility by the EU regulators?
Well, suffice to say that we expect to be re-inspected fairly soon.
All right, ma'am. And another question, and a follow-up question with respect to the emerging market, the EM biosimilar supplies. We did see a little bit of disruption in the second quarter. When can we see normalization?
As I mentioned, all the requalification activities are now completed. So we expect to see a revival starting Q4.
And what's the update on the new biologics manufacturing facility that you have in Bangalore?
Well, we just initiated the construction, so it will take at least 2 years before it is fully complete and an additional 6 months of at least qualification.
All right, ma'am, we'll leave it at that note. Appreciate you joining us today and taking us through the Q3 earnings of Biocon, and all the best to you for FY19. Well, with that, it's a wrap on this edition of Trend Spotting. Thanks a lot for watching the show. Up next is Hot Money. Stay tuned to Bloomberg Quint Live.